In fact, Tanvee Gupta Jain as well as Nilesh Shah also joining us on this edition of our programming. Tanvee, hi, good morning. If I can come to you and take it from where Maithili left off, it looks like inflation forces will continue to be sticky, but at this point of time, the RBI is of course going for growth. They have said that about 10.5% is going to be where we will end as far as FY22 is concerned on the GDP front, and for Jan to March 2021 for Q4 they're pegging inflation at 5.4%. How do you look at the commentary coming in from the RBI Governor Shaktikanta Das? He's of course stood with the government shoulder to shoulder in a bid to push growth.
Thank you. I would say after looking at the budget announcement, today's RBI commentary is extremely in line with the policymakers' common goal that it's all about growth at the moment. So the clear policy priority is to boost growth, and that is exactly what came out in today's policy. The repo rate kept unchanged. The biggest fear of the bond market of how the 12 trillion borrowing calendar is going to be met, considering the RBI, or at least the market perception was that the liquidity policy normalization has already kicked in. I think the RBI kind of elite fears by coming out with very clearly that the monetary policy stance as well as the liquidity stance will continue to remain accommodative for longer. Even the CRR rate hike which is just a a withdrawal of what relaxation was announced in CRI is announced at a very gradual phase, and it looks like that RBI will be announcing OMO purchases to help smooth the bond market fears. So I would say from the growth perspective, RBI mentioned 10.5% real GDP growth estimate for India for FY22. We are at 11.5% year-on-year growth. So I guess there are more upside and downside at the moment on the GDP growth front alone. On the inflation numbers, I think RBI came out with the numbers which are looking a little realistic at the moment, because after revising the March quarter inflation forecast lower, they have really actually increased the first half inflation forecast from 4.8% average to somewhere around 5.1% average right now. So I guess they are cognizant of the upside risk to inflation at the moment, and that is not something in India's story. Globally, we are seeing the risk of inflationary pressures to go up, and that is something we need to be really mindful this year. One last point to add, considering global liquidity continues to be quite supportive, at the same time, it looks like that the government or RBI right now is not so keen on a quick liquidity policy normalization, at least considering the huge borrowing calendar which has to be met by continuous policy support. There is definitely a risk of easy liquidity conditions eventually leading to inflationary pressures building up with a lag. So that is something we need to be mindful, whether there are more upside risk to inflation than what RBI is talking at the moment. But again, I think the wild card is always food. Until the time the food prices could be remained stable, maybe by a better management of supply-demand dynamics, at least half of the inflation basket is something we know is getting into which direction.
Right. In fact, let me also take it across to Nilesh Shah as well. Nilesh, hi, good morning. This is Ruchi Bhatia. I want to first understand from you on the announcement that has been made for NBFCs. The RBI has said that they propose to provide funds from banks to NBFCs under the TLTRO on-tap scheme. This has been a long-standing demand for the NBFC sector. How do you look at this announcement, and do you believe this is going to reduce some of and help the NBFC sector that has been up until now facing a lot of trouble as well?
So number one, this is a very positive announcement because this gives assured financing to NBFCs. Second, they are able to reach to many customers where banking sector is not yet reached. So it provides credit expansion in economy. More importantly, this also brings NBFC firmly under RBI supervision. If you want to take money from RBI, you also have to follow RBI regulation. So effectively, it's good for economy as credit will expand. It's good for NBFC sector as they will get assured funding and some profitability. And it is good for overall credit system as RBI firmly takes over regulation of NBFC.
The RBI's move to open up G-Secs to retail investors. What kind of appetite do you think there will be, particularly in the secondary market?
Lot will depend upon what we do with small savings instruments. If small savings continue to give 1 or 2% more than the gilt, then this step of opening up gilt for retail investors will not really take off in a big way. But if small savings rates are aligned to government securities, then certainly this will entail a lot of retail participation.
On a half-yearly basis, whereas government gilt yields, they do move much more quickly than the small savings rates. So will retail investors really, because the kind of people you're looking at investing in gilts are not the people who put their money in equities. They're definitely more risk averse. So do you see that really happening?
Retail investors, today have bank deposits which are explicitly guaranteed up to 5 lakh rupee by DICGC and implicitly guaranteed by the government of India. You have small savings instrument which is also guaranteed by government of India. So from a credit point of view, they are not really going to find differentiation between bank deposits versus small savings versus government securities directly. The reach and the distribution of banks and small savings is far better than RBI. So unless until we see a scenario where gilt starts yielding better return than bank deposits and small savings instrument, this is unlikely to be hugely popular among retail investors.
Right. Absolutely. In fact, on that note, I'm also going to bring on board Mr. K.K. Mistry from HDFC joining in on the show right now. Mr. Mistry, hi, good morning. Good to have you on the show. TLTROs, Mr. Mistry, for NBFCs, that's important. That's been much in demand for a long time now. Help us understand how this eases things for NBFCs.
Well, I guess it will make the process of borrowing money for NBFCs from the banking system easier and cheaper. So whilst the stronger NBFCs have been having access to funding at a low rate, some of the not so strong NBFCs have been facing some challenges. So this will facilitate the process for them to get money at a cheaper.
Mr. Mistry, do you see banks really taking these LTROs and giving them on to NBFCs, or is it once bitten, twice shy?
No, I don't think so. Why do you say once bitten, twice shy? We just had one instance of NBFC where there was a problem in terms of paying back the liability. So at the end of the day, NBFCs do play an important role because they lend to a segment of the market where banks don't always reach out to with the same degree of efficiency or the same degree of capital. So NBFCs focus on those sectors, lending to those sectors, so they play an important role. And I think this is in recognition of that role that RBI is permitting NBFCs to get money under the program. But we'll have to await the guidelines, detailed guidelines, I'm sure will come in due course.
The RBI's discussion paper having any impact on the view the RBI takes on these kind of instruments in future? Mr. Mistry? I think we've lost Mr. Mistry. Nilesh, my question to you that I was asking Mr. Mistry, which I'm now directing to you, is that how do you see the RBI's discussion paper impacting the RBI's decisions to periodically open the LTRO windows to NBFCs?
I think it's a great move. We have seen many a times liquidity issue impacting NBFCs far more than the credit issue. For some time, we followed a policy where liquidity was defined as -1% to +1% of NDTL. That was like having oxygen as -1% to +1%. Without liquidity, how can banking system or financial system function? Now, in April 2020, we did see upheaval in Indian bond market. In banking system, such upheavals are controlled by RBI, who acts as a lender of last resort. We need a buyer of last resort in the capital market. Participation of NBFCs in TLTRO, opening up of a buyer of last resort by setting up a corporation as proposed in the budget. This will all deepen the bond market. This will all deepen the capital market. So these are all very welcome steps where we are deepening our capital markets.
Join cudgels with you on that. You use the word lender of last resort. Now, the term lender of last resort is something that is used all over the world only, and I repeat, only in the context of banks, because banks alone are given this facility of lender of last resort precisely because of the conditions under which they work, licensing, SLR, CRR, etc. Nowhere in the world is a lender of last resort for the capital markets. For the capital markets, there is no lender of last resort. You only go to the market once again. You either sink or you swim. So I'm little intrigued by your use of the word lender of last resort for the capital market. The capital market is all about risk. Risk and reward go hand in hand. Not in the case of banks, where there is all over the world.
Things have changed significantly. Now central bankers are like Mario Draghi, who says whatever it takes. Bank of Japan is buying equities in the capital market, and they are becoming buyer of the last resort in equity market. So what you have stated is true for 50s, 60s, 70s. What I'm talking about is true for 2020. US Fed intervened decisively in junk bond market. European Central Bank is providing money to South African companies to go and do leverage buyout of European companies. Bank of Japan is buying equities. Time has changed.
But Nilesh, you're comparing apples and oranges. Look at the rate of inflation in Japan. It has been negative for years. Look at the rate of inflation in the US. What is our rate of inflation? What is the percentage of population below poverty line in the US? What is the percentage of below poverty line in Japan? What is our population percentage below poverty line? What percentage does food constitute in our consumption basket? So are you comparing apples and oranges, Nilesh?
So do you want India to become like Japan and US or not? If yes, then we have to follow the same path which they are following. Do you want India to always remain poor?
No, but they have done this.
Obviously not. We all want India to grow. Then we have to do what Westerners are doing, not what they're preaching us. In 1991, when crisis came, what did IMF and World Bank told us? They said, you cut your fiscal deficit, you raise your interest rates, you open up your economy, you devalue your currency, you take the pain. When in 2008 subprime crisis hit, what did they do? They cut interest rates to the board. They raised fiscal deficit to stimulate their economy. So at the end of the day, we have to do what is right for us. Yes, and today, if we deepen our capital market, what is wrong in it? We are not saying that you take the credit risk. This buyer of the last resort in capital market is at a price. No one is buying at par. People will price and they will buy. Let the capital market function at a price. This is about orderly functioning of capital market. This is not about providing subsidy.
But Nilesh, we're talking about, yes, you need to have an economy which grows, but you also have to have an economy where the pain is evenly distributed, not where the census is at 50,000 plus, while the real economy is at minus 7.7. And we are a democracy. Remember, that makes a huge difference. Once we are a rich economy, you can do whatever you have suggested. But can we afford to do it now? Can we not? Should we not have growth with equity?
Undoubtedly, Maithili, but for 70 years we have followed policies which has kept us poor. Now it is time to change policies which will make us rich. We have to create inclusive growth. There's no debate about it. But how do we create inclusive growth? I mean, we won't have time for this discussion. But if you give me 5 minutes, I'll explain how India has handled crisis versus America. In 1929, piano was the second most valued asset in American household because every household had a piano. When Great Depression came, piano became a useless asset. The entire piano manufacturing industry shut down. Piano repair institute, piano coaching institute, piano tuition teachers, they all shut down. There were trucks which were carrying pianos. They all shut down. American allowed destruction of their piano industry. They didn't intervene to support it. Now you look at the textile industry in Mumbai, Lower Parel and all those areas were populated with textile mills. when they came under pressure, we created National Textile Corporation to support them. Those mills were not producing economic output, but government continued to pour money to support them. Now, when market took over, you developed Phoenix Mall, where all the mill workers are getting jobs. There is consumerism going on. Now, should we go creating National Textile Corporation to support, sick mills? Or should we let market function, which will close the mills, but create Phoenix Mall on top of it?
Right. Okay, Nilesh, get your point on that. Let me also take and get across Mr. Yashpal Gupta, the MD and CEO of Repo Home Finance as well. Mr. Gupta, appreciate you taking your time out and speaking with us today at ET Now. What do you make of the announcement that the RBI has made, which is going to, of course, provide TLTRO on tap for NBFCs as well? Your first thoughts?
Yeah, good morning. First of all, my first thought is definitely positive for NBFC. More amounts will be available at lower cost, but this because we do only brief announcement so far. We do not know the details. We do not know whether governor was repeating what they've done in the past or for the future they will do. The details are known whether it will go banks. Last time, as you know, it was through institutions like NABARD, SIDBI and NHB. So, and amounts we do not know. But definitely will credit positive for the NBFC because cost of funds will go down. And liquidity already there is sufficient liquidity, more funds will be available to them. So overall it is positive, but you have to wait for details.
Right. Right, Mr. Gupta. In fact, Tanvee, if I can come to you, one of the announcements today that has been made by the RBI Governor Shaktikanta Das is that of the fact that retail investors can now invest directly into government securities, both primary as well as secondary. What do you make of that announcement that has been made by the governor today?
So I think I would completely agree with what Nilesh was earlier saying, that while it's a very good reform that you're deepening the financial markets, but whether there will be appetite in the sense it is a complete function of the gap between what the small saving deposit scheme is going to be versus what the GSEC yields are going to give you. So, and plus you get some kind of tax incentive up to a certain limit on your investments in a small savings scheme. But I would say from a medium term perspective, the government is definitely diversifying the investment base of who are the participants in the retail or on the funding of the fiscal deficit. And I think that's a good way. Maybe not now, it may not be looking as attractive in the next 12 to 18 months, but over a period of 3 to 5 years, if the government is able to develop and reduce the reliance on NSF funding, I think that can go a long way. So I would say it is first step towards diversifying your investor base, deepening the financial markets. But again, I don't see too much of an impact or too much of a retail participation in the initial phases. I think the bias will always be towards, as a household, if I have additional money to invest, I would prefer to invest in a security which is giving me the highest yields. So maybe a small saving scheme, which there's a strong affinity for last so many years, and plus interest rate being attractive, might give me more solace than versus putting in a RBI-led retail participation in the GSEC market. But I would say from a medium-term perspective, definitely a good step in the right direction.
Okay, I just want to mark what the equity markets and money markets are up to, because you've got the benchmark 10-year yield, which has risen about 10 basis points. We're currently standing at 6.18% versus 6.08 pre-policy. And the markets, by the way, after hitting that magical 15K mark for the first time ever, by the way, we're on the brink of actually breaking into the red. We've completely given up all of our morning gains, and it's a big reversal even for the breadth of the market, which, by the way, cooled off even before the benchmark did. Z down 9.5%, Coforge, Tata Power, Bharti Airtel down 3%, Bandhan Bank is down 3%. Having said that, SBI is still standing pat, 12.5% higher. Godrej Properties, BOB, Kotak Bank, Piramal Enterprises, they're all sitting pretty with their gains, and you're seeing good gains across the pharma universe as well. Cipla, DRL, Divi's, Sun Pharma, they're all holding up very, very smartly. Nilesh, if I could come to you, while we all know that world over, the government and central bankers are trying to boost the economy, knowing that inflation right now may be a necessary evil because you got to boost growth and that needs to be your priority. From an equity market perspective, though, Nilesh, the governor's press conference clearly talked about as to how lower inflationary impulse is correct. That is the need of the hour. But somehow ignoring what's really happening across commodity prices. I mean, you've got steel, plastics, other metal prices, which are only escalating upwards. We've seen some of the earnings also highlight how RM costs are going to only, pick up further for them. You've got crude, which is at a 12-month high. Price hikes by durable companies already have been undertaken from the month of January to lower by to about 5 to 10% a piece or company. You think the equity markets right now should take the governor at face value or try and balance out the inflationary, impact that commodity prices are going to bring on growth and margins of the companies going forward?
See, markets will be continuously processing data. It doesn't take dependence on just one source of information. Now, undoubtedly, inflation seems to be coming back. We have seen local steel prices moving from 40 rupees a kg to 65 rupees a kg. That's a big move. Packing materials are up, and so is chemicals and dyes and various other expenses. Now, the whole point is that, is this inflation sustainable, or is it coming because of supply chain bottlenecks? Now, you know that shipping rates have gone up. Shipping rates have gone up significantly, not because there is shortage of ships, but there is shortage of containers as they are scattered all over the world and they are no longer as efficiently moving as before. Similarly, there has been disturbances on supply side because of COVID-19. If you look at our capacity utilization, we have surplus capacity. On one side, we say that private investment is not taking off because there is surplus capacity. On the other side, we are saying that there is inflation coming because there is shortage of goods. Now, we need to ensure that the supply bottlenecks are removed so that capacity utilization keeps on inching up to meet the demand. If this scenario plays out, it is the best for consumers, it is the best for manufacturers, it is best for economy. And which is where here we need government to play an active role in removing the supply chain bottlenecks. On the other hand, exactly opposite scenario could play out. We'll have lower capacity utilization because of supply issues. Demand will continue to rise, and that will result into price inflation. So we need to work to ensure that our capacity utilization takes care of inflation side problems.
Sure, fair point, Nilesh. Great to have you on the show, Nilesh. We'll let you go on that note. Tanvee, good speaking with you as well. We're going to take a very quick break with news that the equity markets have completely cooled off. We've even breached 14,900 in the Nifty futures right now. Breath at the deep end of the curve. We are a good 110 stocks standing to the declines as we speak. And look what's happening across the money markets. If we can just bring up the bond yields, because the bond market sell-off has only intensified after what looks like a very benign policy from the RBI this time around. Bond yields are at a new 6-month high, like I highlighted earlier. So completely given up all of our morning gains. We're going to take a very quick break, but we're going to continue analyzing the RBI policy in just a short while from now.